Welcome back to the ProTicker Podcast, your Tuesday morning edition covering major financial magazine headlines. Last week was kind of a whirlwind for investors, right?
Mm.
Headlines about everything from soaring oil prices
Mhm.
and tech giants battling these antitrust lawsuits to
Uh,
the U.S. election's impact on market forecasts. Buckle up, we're diving into some pretty fascinating financial trends.
yeah, it's really fascinating to see how these events that seem so different are all interconnected. Like a shift in China's debt strategy
hmm
can send these ripples through global commodity markets, while, a potential breakup of Google could completely reshape the whole digital landscape.
Let's jump right in with a question a lot of investors are asking. Is the S&P 500 overvalued? Bank of America analyst Savita Subramanian certainly thinks so. In a recent note to clients, she argues the index is statistically expensive by nearly every metric, and she points to the current price-to-earnings ratio, 27x, as reported by Bloomberg. What does that number actually mean for our listeners and PISIS? More importantly, what does it potentially signal about future returns?
So the price to earnings ratio, or PE ratio, is basically a way to measure how much investors are willing to pay for each dollar of earnings generated by companies in the index. So in this case, a PE of 27x means investors are paying $27 for every $1 of earnings. And historically, when the PE ratio has been this high, future returns have tended to be lower. And based on this metric, Supermanian projects kind of a dismal 1% annual return for investors over the next decade.
Well, that doesn't sound too promising. But Supermedian does offer a glimmer of hope, Ryan. She notes that S&P 500 companies are now higher quality, less levered, and more asset-light than in the past. Does that offer any potential for returns to exceed those predictions?
Yeah, the composition of the S&P 500 definitely has evolved. I mean, companies are generally more profitable and financially sound than they were decades ago. However, we also need to consider what Supermanian calls dangerously bullish market sentiment. Investors might be overly optimistic about the market's prospects and overlooking potential headwinds.
Okay, so what sort of risks should investors be keeping an eye on?
Well, Supermanian specifically highlights tariffs and rising bond yields as factors that could impact earnings growth in the coming year. These are definitely factors that could disrupt the market's upward trajectory.
And here's where it gets really interesting. Supermanian is suggesting investors consider an equal-weighted index over the traditional cap-weighted S&P 500. She attributes this to what she calls pockets of euphoria around what they're calling the Magnificent Seven stocks: Amazon, Apple, Alphabet, Meta, Microsoft, NVIDIA, and Tesla. Could you unpack that a little for us?
Sure. So the issue is with how these market cap weighted indexes like the S&P 500 function. The largest companies, the ones with the highest market capitalization, they exert this disproportionate influence on the index's performance. So basically this means that the impressive gains of those mega cap stocks, the Magnificent Seven as they're calling them, can create this misleading picture of the overall market health and potentially masking struggles faced by, a broader range of companies.
So rather than blindly following the headline S&P 500, investors should be more selective and consider all those nuances of the market. Now let's shift our focus from the U.S. over to China, where we're seeing a pretty significant development. Bloomberg reports that for the first time, China is redirecting funds from new special local government bonds to pay down existing debt. Typically, these bonds have been used to finance infrastructure projects, which are crucial drivers of economic growth. So what does this shift signal?
This is a pretty clear sign that China is, increasingly concerned about its debt burden, and it represents this strategic pivot, choosing to prioritize debt management over new infrastructure investment. We're talking about a shift of 800 billion yuan, roughly $110 billion, annually until 2028. So that's a significant amount of money diverted away from infrastructure spending.
And this comes at a time when the Chinese government is aiming for, a 5% growth target, according to sources like Bloomberg. How might this reallocation impact those economic ambitions? And what does it mean for investors with exposure to the Chinese market?
Well, it's a complex balancing act. Addressing the debt is crucial for long-term economic stability. However, scaling back infrastructure spending could hinder short-term growth. And this shift is driven in part by China's property market crash, which has really severely impacted the financial stability of local government financing vehicles, or LDFEs.
Can you explain what LGFEs are for those who might not be familiar?
Yeah, so think of them as separate entities that are set up by local governments to finance infrastructure projects, and they allow these local governments to raise funds without directly adding that debt to their balance sheets, However, the property market crash has, significantly weakened these LGFVs, making it much more challenging for them to support new projects.
So we're seeing this chain reaction. Property market crash weakens LGFVs,
Yeah.
prompting the central government to prioritize debt repayment over new infrastructure spending, potentially putting a damper on their 5% growth target.
Exactly. And this situation bears close watching, as it could have, global implications. A slowdown in China's economy can ripple outwards, impacting demand for commodities, global trade patterns, and even the performance of stock markets around the world.
It's a reminder that global markets are deeply intertwined, and events in one region can have these far-reaching consequences. Now, turning our attention back to the U.S., another major headline has captured everyone's attention. Google is facing this intense antitrust scrutiny, and the Department of Justice is specifically targeting its Chrome browser. This is big news, potentially reshaping the online search market and the rapidly growing AI industry.
Yeah, the core of the issue is Google's dominance in search. And Chrome, as the world's most popular web browser, plays a crucial role in maintaining that dominance. It gives Google this unparalleled access to user data, which fuels their advertising revenue and their aggressive push into artificial intelligence, particularly with their new AI product, Gemini.
And it's not just speculation, is it? The Wall Street Journal reports that the DOJ is actually pushing for Google to sell off Chrome. That's a pretty drastic move. Why go after the browser so specifically?
It's all about controlling the gateway to online information. Chrome's massive market share, about 61% in the US according to StatCounter, gives Google this tremendous power to direct user traffic and collect data. And this data is incredibly valuable, not just for targeted advertising, but also for training and developing their AI technologies.
So the DOJ is aiming to disrupt Google's data flow by separating Chrome from the rest of the company. But are there other demands on the table besides just the Chrome spinoff?
Yeah, the DOJ is taking this multi-pronged approach. They're pushing for data licensing requirements, which would compel Google to share its vast reserves of search data with competitors. They're also seeking changes to how Google bundles its Android operating system with other products, like Search and the Google Play Store. And they're advocating for greater transparency for advertisers, giving them more control over where their ads are displayed.
Sounds like a full-scale assault on Google's ecosystem.
Hmm.
The article mentions that Google is pushing back hard, calling these demands a radical agenda. They argue that these measures would harm consumers and stifle innovation. What are your thoughts on the response?
Well, it's a very complex issue with valid arguments on both sides. Google has undeniably played a pivotal role in making the internet more accessible and user-friendly. Their innovations have benefited billions of people worldwide. However, their dominance does raise these legitimate concerns about fair competition and potential abuse of market power.
It's this delicate balancing act, isn't it? Trying to foster innovation while ensuring a level playing field for competition. So the question everyone's asking is, could a Chrome spinoff actually happen? And if it did, what would the implications be for the average internet user like you and me?
It's tough to say for sure. First, the judge would have to rule in favor of the DOJ's demands, which is far from guaranteed. And even if that were to happen, finding a suitable buyer for Chrome would be a major hurdle. Amazon and OpenAI have been mentioned as potential candidates, but each faces its own set of antitrust challenges. I mean, the outcome of this case could have significant ramifications for the future of the internet, impacting everything from how we search for information to how AI technologies are developed and integrated into our lives.
It's definitely a story with far-reaching consequences, and we'll certainly be keeping a close eye on it. Now let's shift gears once more and touch on some other notable financial news from the past week. The dollar continued its climb against the yen, fueled by rising U.S. Treasury yields and persistent uncertainty surrounding the Bank of Japan's future policy decisions.
Yeah, it's a tricky situation for the Bank of Japan. They're trying to navigate this delicate balance, aiming to control inflation while simultaneously supporting economic growth. And the yen's weakness against the dollar further complicates matters because it makes imports more expensive, which could potentially fuel inflation.
This is where we'll pause for now, but don't go anywhere. When we come back, we'll continue our deep dive, exploring more market trends, economic headwinds, and some more fascinating financial stories. You won't want to miss it.
It's a real tightrope walk for policymakers,
Yeah.
trying to juggle all those competing priorities.
Absolutely. And in the world of precious metals, we saw gold rebounding after a recent dip. A CNBC article attributes this bounce to a pause in the dollar's rally. What's your take on the relationship between the dollar and gold?
Well, it's a classic inverse relationship. When the dollar weakens, gold often becomes more appealing to investors who are seeking, a safe haven asset.
Makes sense. We've also been seeing a real mixed bag of forecasts for the stock market. Goldman Sachs, as reported in a note to clients, is projecting an 11% gain for the S&P 500 in 2025. They're banking on continued economic growth, strong earnings, and a stable valuation multiple.
It's a pretty bullish outlook, but it's important to remember that it's just one projection. As we talked about earlier, Bank of America has a much more cautious perspective. They're cautioning about the S&P 500's elevated valuation and the potential risks to earnings growth. So investors are getting these conflicting signals, which can make decision-making, pretty challenging.
Yeah, it really highlights the importance of doing your due diligence and not relying on, any single forecast. And speaking of challenges the airline industry offers a stark reminder of, the turbulent skies smaller carriers are facing. Spirit Airlines filed for bankruptcy less than a year after a federal judge blocked its proposed merger with JetBlue Airways. The Wall Street Journal did this really interesting deep dive into Spirit's trajectory, highlighting how their ultra-low-cost model, initially a recipe for success, ultimately became unsustainable in the face of fierce competition and rising costs.
Yeah, it's a real cautionary tale about the fragility of even
Yeah.
these innovative business models in these rapidly changing industries. Sometimes what works in one market environment can become a liability when the winds shift.
Yeah, absolutely. And finally, oil prices experienced a surge, exceeding 3%, driven by a production outage in Norway and those escalating tensions surrounding the Russia-Ukraine war. CNBC reports that the outage at Norway's Johan Sverdrup oil field, one of Western Europe's largest, has amplified concerns about supply disruptions.
And those geopolitical tensions swirling around the Russia-Ukraine conflict continue to inject a ton of volatility into the oil market. The Biden administration's decision to permit Ukraine to target military sites within Russia has further escalated the situation, raising concerns about potential retaliation and further escalation of the conflict.
It's a complex geopolitical chess game with real-world consequences for energy markets and the global economy. Before we wrap up today's deep dive, there's one more intriguing article from MarketWatch I wanted to touch on. It discusses a market signal that's flashing a warning. For the first time in over a decade, something called the Fed model.
The Fed model. That's a concept that has sparked, ongoing debate among market observers for
And for
years.
all listeners who might not be familiar with it, could you break down what the Fed model is and why it's suddenly garnering all this attention?
Yeah, so it's a fairly straightforward concept at its core. The Fed model compares the earnings yield on stocks to the yield on the 10-year Treasury note. So when the earnings yield on stocks surpasses the yield on 10-year Treasuries, it suggests that stocks might be undervalued, and that presents a potential buying opportunity. Conversely, when that earnings yield falls below the Treasury yield, it's viewed as this warning sign that stocks could be overvalued.
Interesting. And the article points out that for the first time since the 2008-2009 financial crisis, the Fed model is flashing that warning signal. The S&P 500's earnings yield currently sits around 3.9%, while the 10-year Treasury yield is hovering around 4.46%, and this has some market bears feeling pretty confident that a correction's on the horizon.
However, it's really important to emphasize that the Fed model's long-term track record is, at best, weak. There's considerable debate about its reliability as a market timing tool.
Yeah, the article really delves into a key criticism of the Fed model, arguing that it essentially, compares apples to oranges. The stock market's earnings yield is a real yield, meaning it's adjusted for inflation, whereas the 10-year Treasury yield is a nominal yield, not factoring in inflation.
That's a really valid point. By comparing a real yield to a nominal yield, you don't get a truly accurate picture of the relative attractiveness of, stocks versus bonds. The article even cites research by Cliff Asness, the founder of AQR Capital Management, who contends that the Fed model has the appearance, but not the reality of common sense.
So while the Fed model's current reading might raise some eyebrows, it's probably not a reason to panic and liquidate your entire stock portfolio.
Exactly. It's just one data point among many, and it's crucial to consider that broader economic and market context.
It's a good reminder that context is everything when navigating the complexities of the financial world. We've covered a lot of ground today, from anxieties over market valuations and potential antitrust battles to China's struggle with its debt burden, and the ripple effects of the Russia-Ukraine war on energy prices. It seems there's never a dull moment in the world of finance.
It certainly keeps things interesting, doesn't it? And it highlights how interconnected the global economy truly is. A production hiccup in one corner of the world can cascade through energy markets. And political decisions in one nation can have significant consequences for investors across the globe.
It's a lot to keep track of. But that's why we do these deep dives, to help you, the listener, decipher the headlines and grasp what it all means for your financial decisions.
Yeah.
Yeah, it really is a lot. It's a reminder that staying informed and adaptable is key to navigating these financial waters. So as we wrap up our deep dive into these headlines, I'm curious what stands out to you the most. What's like that one key takeaway you hope our listeners will kind of carry with them?
Well, I think amidst all the noise and complexity, the most important thing is to really stay focused on your long-term financial goals. Don't let the daily market fluctuations or these attention-grabbing headlines really dictate your decisions. Instead, concentrate on constructing this diversified portfolio that aligns with your individual risk tolerance and those long-term financial aspirations.
Yeah, it's so easy to get swept up.
Yeah.
And the market's emotional roller coaster, right?
Yeah,
But having that clear plan and the discipline to stick to it is so essential.
absolutely. And remember, you don't have to navigate this landscape alone. There are so many resources available to empower you to make these informed decisions. Financial advisors, reputable financial websites, and even, insightful podcasts like this one can offer valuable guidance and perspectives.
That's a great point. Sometimes having that trusted source to help you cut through all the noise can make all the difference. We've certainly covered a lot of ground today, exploring everything from concerns about market valuations and the potential restructuring of a tech giant to China's grappling with its debt and the impact of geopolitical events on energy markets.
Yeah, and all these stories, as we've seen, they're so intricately interwoven and just highlights the importance for investors to really stay informed and remain adaptable.
Exactly. We hope our listeners have found this deep dive informative and helpful. And remember, we'll be back tomorrow morning with a fresh batch of market-moving headlines from major financial magazines